And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. On Friday, the SEC chose not to appeal an important case on a spot Bitcoin ETF, making that long-awaited ETF much more likely. Joining us now, someone who very much has a dog in that fight, ARK Invest CEO Cathie Wood. Also joining us, Tom Lydon, Vice Chairman of VettaFi. Cathie, you're one of the 9 applicants for a spot Bitcoin ETF. It does look like the SEC may be forced to approve a spot Bitcoin ETF. Can you tell us what, if any, communications you've had with the SEC and what else we might know about this? How do we push the ball forward here?
Well, actually, our partner, 21 Shares in Europe, did answer or send in information in response to SEC questions. And we sent them in on Thursday, I think, or it was publicized that we did. So what we see here is a little bit of a change in the SEC's behavior. They actually are asking questions, and we provided 5 pages along with our partner of answers to those questions. So progress, we would say, yes.
Yeah, one thing I noticed, Cathie, is that the interest in Ether futures ETFs, which only started a couple of weeks ago, and we had some of the people on from ProShares involved in that, has been rather muted since they were introduced a couple of weeks ago. I'm wondering if a spot Bitcoin ETF is really going to move the needle this time. It's interesting because Bitcoin's been sideways for months, and yet we've known that this ruling came in, and it's known that they likely may not appeal, and yet doesn't seem to be moving Bitcoin. It's up a little bit today. Is interest a little more muted in Bitcoin than it used to be?
You know, judging by the questions we're getting, no. I think many people focus on our price target for Bitcoin, and our base case is over $600,000 by the year 2030, and they really want to understand that. So maybe they're just trying to understand our research, but there's definitely a focus on, is this a new asset class that I should investigate? And I would say institutions, especially, when they see the SEC seal of approval in this way, I think this will finally bring institutional interest into Bitcoin.
Are you on board with that idea? I mean, what's interesting to me, and the reason I ask is when the Bitcoin futures ETF launched, BITO from ProShares, we had Simeon Hyman on. Yeah. This was, almost 2 years ago, and boy, interest was through the roof on this.
$1 billion in a day,
huge.
Right?
And we've got a few $1 million in the Ether futures. Am I being petty here? Or
No, I don't think so, Bob. I think we're at a critical point in time. This issue with Grayscale is forced the SEC's hand. And really, up until Friday, when they had their deadline, the SEC and Grayscale just weren't talking. Now that they've passed on this appeal date, they're forced to have a conversation. All during the last few weeks, though, they've been talking to ARK, they've been talking to all the other applicants, which gives good confidence that this is going to happen. And when it does, it may take a few months. We do a lot of surveying, as you know, with the folks at Bitwise and advisors for the last 5 years. The big issue is they don't feel like they have real access to cryptocurrency just because of their platforms. Now, if we have a spot opportunity in a whole variety of different issuers, that will change.
So you agree with Cathie's point that this will increase institutional interest?
It absolutely will. Okay. Yeah, because it's on platforms as opposed to exchanges that still aren't regulated.
Yeah. So my understanding here is the court will issue its mandate. It'll tell the SEC this is what you have to do to be in compliance, and they'll move from there. We should know fairly soon about what's going to happen here. Let me just move on, Cathie. Your flagship ARK fund is up 20% this year, but you've had outflows, and so have other tech funds. So tell us about that and what impact higher rates might be having on your holdings this year. That seems to be the big issue.
Yes, well, we can tell we're not in a hugely speculative environment. A lot of people were worried about a reincarnation of the tech and telecom bubble with all of the chat GPT and artificial intelligence hype out there. We don't think it's hype. We think there's something very profound going on here. So you can see interest rates and fear of higher for longer has hurt our performance since July, and I would say most other growth managers. And I do think that we're seeing many investors kind of pull back into cash, which is yielding 5% plus, and even into long bonds. And watching the flows into long bonds gives us great hope. If investors, bond investors, are beginning to see the peak in interest rates, which is why they would invest in a bond fund, then that should be very good for us. And I think if you listen to company reports, and I know economic statistics are all over the place, but the company reports are coming out solidly that inflation is coming down and activity is weakening. I give Domino's and LVMH two ends of the price spectrum for consumers, and both of them last week said it's weak out there, especially in the United States. So I think we've been through a period of rolling recessions. Housing, by some measures, down 40 to 50%. Autos very sluggish at near recession levels. Inventories not really contributing anymore. So now I think the consumer is going to follow through and probably pull back a bit. And that will, we think, then highlight the superior growth in our portfolios as they are recession resistant.
So how about that? She's saying essentially investors are top ticking the yields right now. We've seen big inflows into bond funds. You and I have talked about it this year. Even longer term funds like the iShares 20 plus, the TLT. My heavens, we've seen 20 billion in inflows into this thing this year. 4.3 billion in the last 3 months. Even though it's had a lousy performance, it keeps going down, meaning the yields keep going up.
Right.
We're like 20% off its 52-week high here.
So Kathy's point here is once we get to the point where the Fed is done hiking rates, most advisors, when we survey them, say a year from now rates are going to be lower. So what does that mean? Not only do you need to go longer duration and lock in these rates, but you're going to be able to participate in the appreciation. We haven't said that word in a long time, but appreciation in bonds. And if you're sitting there on the sidelines, like $7 trillion sitting there in money market funds, yes, it's getting 5%. But you're not going to participate in that appreciation once rates start to go down.
That 6 trillion or 7 trillion seems really sticky. I mean, the viewers I've talked to, they seem very happy. That's the concern that I have. I'm not trying to be argumentative with Kathy, but they seem very happy with their 5% coupon clipping. Kathy, how do you tell those people, come on, let's get in the stock market here? Don't you have any FOMO at all? Doesn't that worry you a little bit? They seem happy there.
This is what happens near the end of any cycle like this. The fear, and now, of course, we have the situation in Israel adding to the fear of oil prices continuing to go up. So there's a lot of fear pushing people towards cash or making them feel comfortable in their cash. But mind you, if they see the prospects for interest rates actually coming down, then they will probably, as you say, $7 trillion, some of it will probably start migrating in a rebalancing way back to equities, and we're already seeing it in bonds.
Kathy, a year ago, I asked you if you were sitting across the table from an advisor that bought ARKK in the spring of 21 and was there with a fairly significant decline, what would you say to them? And would you repeat that? And do you still have the same feelings today?
Yes. Well, what I probably said back then is if you have a 5-year investment time horizon, we believe that these 5 innovation platforms, which are evolving all at the same time, hasn't ever happened in history, are going to cause not just exponential growth, so good growth rates sustained, but super exponential growth, very good growth rates accelerating as we move into technologies like autonomous taxi platforms, where 3 of our major innovation platforms, robotics, energy storage, and AI, will come together. Those are 3 platforms that are ready and are in the middle of prime time, and we think are going to deliver superior growth beyond what we're used to when we say this exponential growth phrase, because it's one technology feeding another. So, Again, we do a lot of research. We give it away. We give some of our models away, especially those where we feel there's a big inefficiency or misunderstanding. And you can see the building blocks behind our forecasts and change the variables if you want to. But our confidence, if anything, has increased because of what's happening with artificial intelligence. Finally, ChatGPT captured the imagination of the investor. We had been talking about artificial intelligence since the firm started in 2014. And we had been very focused on NVIDIA as the pure play in this space. So we were there when NVIDIA was 5. We're on to the next thing now. And I would say you're picking early 21. The drop from early 21 in our strategies to the low was worse than the tech and telecom bust, which makes no sense. Back then, the technologies weren't ready and the costs were too high. We didn't have the cloud, we didn't have deep learning and AI, we didn't have transformer technology. We were not ready for prime time and the costs were prohibitive. Today, and yet investors were chasing the dream back then. And that ended badly. Today, talk about investor psychology. We're ready for prime time. The dream is no longer, it's a reality. And investors are so fearful. And so we think that the surprise element out there, as our companies take off and harnessing these new platforms, the element of surprise is going to be significant, and we will earn our way back into portfolios. There are many who stuck with this and averaged down all the way. We think they will be rewarded handsomely if our research is correct. We think it is correct. Of course, we could always be wrong.
So the big story, you mentioned AI. Let's just stay on that topic. I look at your largest holdings in your main ARK fund. I see Tesla, Coinbase, Roku, Zoom. I know you've talked about Tesla and AI, NVIDIA and AI, but describe AI's exposure in your portfolio. Where does it help other than Tesla, which you've talked about before, NVIDIA? Look at all these other ones we've got here: Twilio, Roblox, Unity, some of the other ones, Block as well. Speak about it broadly and where it fits in here.
Sure. Most of the stocks in our portfolios are there because we've used an AI lens. Now, we wrote a paper called Investing in Artificial Intelligence, Where Will Equity Value Surface? It's on ark-funds.com. Now, I think many people feel comfortable. They're on the right horses, the mega cap tech companies or the Magnificent Seven, one of which is Tesla. So we clearly agree with that one. We are not sure when it comes to the others. We think that AI is going to be highly disruptive, is going to disintermediate some of these platforms, not all of them, and that it may be the worst thing that has happened to a company like Google. Google, if I can go to ChatGPT and just get an answer right away and not be bothered with links and advertisements, I might do that. Well, guess what? Google is responding and now giving me answers. So it could be the best thing that happened to Google. We don't know. All I know is that when there are major changes in platforms, especially user interfaces, now that we're thinking about glasses and other wearables, the winners of the last round in technology typically are not the winners in the next round. So we're on guard in that regard. And we know that most large cap portfolio managers own all of these. Our portfolios are a highly diversified way to participate in artificial intelligence. For every dollar in hardware that companies spend on artificial intelligence, it will probably pull $20 through in software. So that's why you see a company like UiPath, Robotics Process Automation, which we think is harnessing the foundation models that OpenAI, Anthropic, and others, Meta's Llama 2, it's harnessing those foundation models, but is using specialized models with its proprietary data to become the robotics process automation company in the world, the largest. And same with Twilio. What kind of data? And you'll hear four variables that we think are critically important as all companies approach AI and try and figure out, how can I harness the productivity gains from this new technology? One is they have deep domain expertise. They obviously know what they're doing, and they have a vision about where their own technology and company is going in the future. They have artificial intelligence expertise. They're taking this seriously. They have good distribution, preferably global, not always. And then most important beyond that, they have proprietary data. And most of the companies you'll see in our portfolios have proprietary data that no one else has that they can use to help their customers. Twilio is another example, 1 trillion business consumer interactions every year and growing at an accelerated rate. They can help marketers and salespeople understand, hey, these were the interactions that caused movement towards your company or your product. That is very valuable information that nobody else has.
So here's another, what she's saying is essentially this is a variation on software eats the world. It's just a more advanced kind of software that eats the world that makes things more productive and efficient. I mean, what she was saying with proprietary data, we had a couple companies go public here in the last couple of months, and one of the things they told me was they get hired to have access to the databases of various companies and provide high-level analysis. AI obviously is a higher level analysis than you can provide. So what she's saying makes perfect sense in terms of improving productivity for companies that are using the software around this.
Well, not only that, the amount of growth, and Kathy and her crew have always been proponents of growth. It's not just earnings, but the growth that you have in the stocks that you buy, and then being able to pick the right stocks at the right time with the right allocation. And that's what ARK's been all about. Kathy, I just want to use this quick opportunity. I know you have a Israel Innovation Technology ETF. Can you just spend 30 seconds on that as far as what's going on over there? I know it's a very, very difficult time, but you're investing in Israel right now. What's happening?
Yes, so this is a self-indexed fund. Any company based or headquartered in Israel that touches any of our innovation platforms is included in this index, and it is rebalanced quarterly. When historically, when we've been through very tough times, including war times, this notion that innovation solves problems really is it really helps investors get over humps like this one. So here we are, we're revisiting lows with the Israel Innovation Technology Fund. And yet the innovators in that fund are going to help some of the problems that are being created by the crisis in Israel right now. And especially any company whose margins are under pressure and is suffering as a result of what's going on. Harnessing the new technologies that these companies, the companies in this portfolio and other companies around the world are providing, is going to help them shore up their margins better, cheaper, faster, more productive, more creative new products and services. So we think, and we've always seen innovation gain traction during tumultuous times.
All right, I got to ask you about Tesla and Elon. Tesla's still your largest holding. It's up 100% this year. You got a real winner there. Has Elon Musk been able to refocus on Tesla now that he has somebody else running X? Do you have any insight into that or feeling about that?
I think that Elon is a troubleshooter, and the troubles at X are not over yet, of course. We're seeing that in just recent days when they've said, the Israeli conflict and all of the drama around it has caused another hit to advertising revenues. So I think these difficult times, though, spur Elon's creativity. He is a troubleshooter and a brilliant technologist. So we think that each time he does face turmoil like this, that the intensity of his brain cells takes him to new answers. And, we've seen this at Tesla every step along the way. Tesla, now that EVs are scaling and he's got that machine in place, so to speak, we have now the autonomous side. And I think he's really focused on that. So, yes, I think it has his attention. He knows and believes, I think, that they're close to the finish line with this latest software upgrade, so much so that they're now hiring ride-hail experts in different cities around the country. That is going to be a game changer. And we don't think he's lost any focus.
Great. Good to hear that. Now, you recently entered the European market. You bought Rise ETFs in the hopes of bringing, I think, thematic investing strategies to Europe. Can you convince European investors to buy into your philosophy of very concentrated tech bets? I know you're still pretty small over there.
Yes. So, well, we don't have any product offering out there in the form of a UCITS ETF. And that's what we were missing. Since we were formed, I'm going to say for the past 7 years, 25% of the subscribers to our research, now we give our research away for free, but 25% of the demand is from Europe. And the number one question on our website as we track these questions is, why can't we buy your strategies in Europe? And so here we found this little gem of a company inside Asset Co, which philosophically and from a DNA point of view is very much like ARK. They know what's in their portfolios. They're very focused on the future, thematically oriented. They do have a sustainable orientation, which is absolutely essential in Europe. And in fact, more than half of their funds are Article 9 funds, whereas I think only 4% of all the funds in Europe are Article 9 funds. So we're terribly impressed with the quality of their own research and due diligence. We saw it during the deal. And I think we're going to hit the ground running if the regulators approve our strategies there. And then, of course, we'd like to distribute their strategies throughout the world, including the U.S.
Tom, European distribution's a challenge, even for big American companies. How is it different than the U.S. getting it out in Europe? And Kathy's got big brand name recognition. Is that enough to break into the European market?
Well, I think like Kathy was saying, they know of ARK, they know of Kathy. She's a rock star here in the States, but also over in Europe as well. The problem is, how do I get invested? A lot of Europeans actually find a way to buy the ETFs, the ARK ETFs listed here, but fast forward, this new UCITS strategy is really a mutual fund or ETF strategy for Europe. The problem is every country has different regulatory rules and regulations that you have to jump through. The good thing is the UCITS product can be sold throughout Europe, and I think Kathy's going to find a way to do that. The great thing is people already know her, and there are also people that love the research.
Yeah, she's certainly a well-known name here and in Europe. I'm going to have to leave it there. This has been a great conversation. Kathy, thank you so much for joining us. Tom, you as well.
Thank you, Bob. Great to see you.
We've asked Tom to stick around and chat about where ETFs are going into the end of the year for our ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.